Hello, everybody, and welcome into Commodity Culture, where we break down commodities markets with the goal of making you a better investor in the sector. My name is Jesse Day. Today is April 14th, 2026. And before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's guest is the founder and publisher of Mining Stock Monkey, a research service providing dynamic financial modeling and institutional quality research to find the massive disconnect between price and value, along with the host of the Mining Stock Monkey YouTube channel. It's Jordan. Great to have you back on the show.
Hey, thanks for having me back. I appreciate it.
Now, I know you're mostly focused on the micro, trying to find companies that are trading at a significant discount to their intrinsic value. But if we take a step back for a moment and look at the macro, what are you seeing in the economy right now? And how is that affecting investments that you're making today?
Yeah, Jesse, like you said, I focus most of my efforts on the micro, looking at individual companies. But I do think it's important to take a step back once in a while and look at the overall big picture of what's happening in the economy with particular commodities. And it's been a long time since we've had a recession. The last time we had a recession was about 2008, 2009. So we're going on like 17 years. And I'm not counting 2020 because the government forced everybody to stay home. So the government created that, not economic forces. Because of course, if you don't allow people to work, you're going to have economic contraction. So I don't count the 2020 as a recession. So considering it's been about 17 years, that's much longer than normal. So something I did recently, I went in and I tried to dig in to figure out how likely it is that either we're in a recession now and we just don't know it yet, or we're going into recession. Because I was watching an interview from Jamie Dimon, the CEO of JP Morgan Chase, and he was expressing concerns about a recession. And I mean, Jamie Dimon is one who really has his pulse on this. So this is something that caused me to dig into this. But I was looking at various things, and I'll just go over them. So for example, credit card debt. In the US, there's record levels of credit card debt. And while this isn't dire, it's concerning. And it's kind of bifurcating. The top 40% are doing fine and are deleveraging, while the bottom 60% are really struggling. So when it comes to credit card debt, we're seeing delinquencies being pretty high. We're seeing defaults increasing. It's not at the point where it's dire yet, but it's getting worse. So there's that. But also there's a new kid on the block. There's this buy now, pay later, there's these buy now, pay later companies that are getting really, really popular. And up until now, these buy now, pay laters haven't really been reporting to the credit agencies. So, for example, you have somebody extending somebody credit for a car loan, somebody else extending somebody credit for a credit card. Those are appearing on the person's credit profile, and those lenders can see their debt to income ratios, right? But then you have buy now, pay later that wasn't showing up. And buy now, pay later has gotten extremely popular. And it's getting close to the $1 trillion mark of the number of transactions. And something we're seeing that's concerning is that a lot of people are starting to use buy now, pay later to buy their groceries, to buy necessities. And while that's fine if you do it once, if you start doing it and you do it every week to buy your groceries, 8 weeks from now, you still need groceries, and you have to make the payments for the last 7 weeks of groceries. So that's concerning, and I think that's going to increase the delinquency rate and default rate of other loans as well. And then I started looking at car loans, and car loans is where actually perhaps where it gets really ugly for me. So subprime auto loans are at their highest delinquency rate in 30 years. 30 years. So worse than COVID, worse than the Great Recession. And something that's happening in the auto market or something that has been happening in the auto market with these auto loans is people are trading in their old cars for a new car with negative equity. So the car's worth less than what they owe on the loan. And then they're trading they're taking that loan and then they're bundling it into a new loan. And then as soon as they drive their new car off the lot, the value of that car shrinks. And a lot of these car loans are at 120%, 130% loan to value. So what does that mean? Well, that means the banks are taking on a lot bigger risk, because if somebody defaults and they have to repossess the car, normally they send that to auction and they get about 70% of the car's value at auction. Okay, so they lose 30%, or well, let's say the loan to value ratio was 100%. And they send the car to auction, they get 70% of that value, they lose 30% of that, right? But I mean, if the loan to value of that was 70% instead of 100%, and then they sell the car for 70% of its value at auction, well, then they get all their money back. They recover the money for that loan, and they're no worse off. The consumer is, because the consumer doesn't own a car anymore, but the bank is fine. But today we're in a different situation. So when you have a loan to value that's 130%, and then the customer defaults and they have to repossess the car and then they sell it at auction for 70%, they're losing about 60% of the value of that loan. That destroys their balance sheet really quickly. And also, when you have a high loan to value, it makes defaults more likely, because the person who owns the car or is making the payment is like, hey, I have huge negative equity in this. So, I mean, it makes sense for me to stop paying the monthly payment, and maybe I'll be able to keep the car for a few months before they repossess it. But then you also have this new thing where gas prices have suddenly shot up. And a lot of these car loans that have these huge loan to value ratios are big SUVs, gas guzzling trucks. So you have somebody who's struggling financially, who suddenly has to pay way more for gas because gas prices are so much higher. And they have a car loan where the loan is way higher than the value of the vehicle. So this is setting up a whole bunch of reasons for them to stop making payments and to default on their loan. So that's really concerning for me. And then if you look at consumer sentiment usually precedes a decrease in spending in the economy. Or if consumer sentiment falls, that usually happens before spending comes down. And the latest consumer sentiment numbers shows that we are at record lows, worse than COVID, worse than the Great Recession, record lows. So that tells me that the average person out there, the average Joe and Jane, is really struggling, and they're going to be reining in their spending. And when that happens, GDP comes down, or GDP shrinks or doesn't grow as fast. And I almost forgot to mention one other thing. You have student loans. So the delinquency rate on student loans has jumped up enormously. It went from like 1% to 16% or something like that. And then with the Big Beautiful Bill Act, a lot of the people who were paying $0 to $50 a month on their student loans, less than what they were accruing in interest, come July 2026, the average payment is going to jump up to about $450. So you have all these people who are already struggling, who are going to have to start making a much bigger payment on their student loans. And a lot of times the student loans is the last thing people pay. If they're struggling, they pay their house, they pay their car, they pay their credit card, but the last thing they stop paying or the first thing they stop paying is their student loans, because it's the thing that affects them the least in their day-to-day life. But before, student loans weren't reporting to the credit agencies. So if you defaulted on your student loans or you were delinquent, it didn't affect your credit score. But now it does. So now if that happens to somebody, their credit score drops by 50 or 100 points, effectively eliminating them from the credit market, and no lender will extend credit to them, which again will contribute to a contracting economy. And also with a large part of the problem with the auto loans is subprime. But then with student loans, I think this problem has potential to get into prime borrowers, because these are people with college degrees who might be doctors or lawyers or have other high paying careers. And if suddenly they have to start making $1,000 a month or a $2,000 a month student loan payment that they weren't making before, that's $1,000 or $2,000 that they can't spend in the economy. And I think that's going to contribute to a contracting economy. All that to say is that I don't know if we're in a recession yet, but it sure looks like the chances of us heading into a recession are quite high. And I think my new investments need to reflect that. For example, I'm very interested in copper over a 5-year time frame, but copper gets killed in a recession. So I have copper companies on my shopping list, for example, that I would be looking to deploy heavily in the case that the copper price collapses in a recession. So hopefully that gives you a decent overview of the research I've done into the credit markets and what's kind of happening.
Yeah, that was a very thorough and interesting breakdown. I think recently no image or video perhaps portrays this issue happening with the economy than a grandma having to deliver DoorDash to President Trump as he stood there in front of these golden accents on the outside of the White House that were worth more than her yearly salary. So I think it's tough times around the world at the moment, particularly with the blockage of the Strait of Hormuz and the issues going on with the war in the Middle East as well. Now, I want to touch on something you wrote about this gold bull market in one of the recent issues of Mining Stock Monkey. You said, this gold bull market began roughly a decade ago after the late 2015 bottom. While the macro tailwinds, specifically the sovereign debt spiral and the weaponization of the dollar, remain valid reasons for gold to continue higher, we must acknowledge that at 124 months, this cycle is entering overtime relative to historical averages. Now, of course, this begs the question, is it different this time? Sir John Templeton said those are the most dangerous words in investing. He also noted that around 20% of the time, it really is different. I'm wondering what your take is here on this current gold bull market.
I think we need to take a look back. You have to look at the bearish argument or why we could be approaching the end of the bull market. And you also have to take a look at the bullish argument, why it will continue. And what I've concluded from that, your listeners are going to hate this answer, is I don't know. I don't know if this bull market is going to go on longer than previous ones. But the longest one we've seen so far, at least since the 1970s, when the U.S. government removed the $35 price fix on gold and once again allowed U.S. citizens to own gold. The longest bull market we've seen was approximately 125 months, and we're 124 months into this one. Could it go 150 months, 200 months? Sure. Will it? I have no idea. I do see, like you mentioned in that, when you were reading out that thing I wrote, I do see macro tailwinds for reasons why this gold bull market could continue, but I don't know. However, because I don't know, this makes me want to kind of shift some of my investments, because there's certain investments that perform better in the later stages of a bull market or when the bull market reverses.
Well, you've talked about prioritizing downside protection because if you protect your downside, the upside takes care of itself. How do top tier precious metals, royalty, and streaming companies, because the point that you wrote in that letter was that that's kind of the place you'd rather be as we potentially enter the latter stages of a gold bull market. How do those types of companies like Royal Gold, Franco-Nevada, Wheaton Precious, how do they play a role in your strategy compared to traditional miners?
Yeah, sure. But before, to set me up with that answer, I want to tell you about a producer, a gold producer, as the bull market turns from a bull market into a bear market. Okay, so let's say you have a gold producer that's producing with 50% margins. So if gold is $4,700 an ounce, they're making $2,350 on every ounce they produce. Okay, but if we're at the end of a bull market and the gold price falls by 30%, the margins of that 50% margin gold producer, well, instead of making, like, let's just say it's somebody who's producing 100,000 ounces a year. At 100,000 ounces a year, they're making like $235 million. And then if the gold price falls by 30%, they're only making about 90 million or a little over 90 million. So even though the gold price fell by 30%, their margins collapsed by 60%. So that's why it's more dangerous to own the producers as you get to the later stages of a bull market. And the higher the cost of the producer per ounce, the more danger there is. So a lower cost producer has less danger than a high cost producer. And it especially gets dangerous for the stock price if they also have debt. Because if the gold price turns and then suddenly their margins collapse and the market is worried about if they're going to be able to service their debt, well, then the stock price can really collapse. Like in the case of where their margins go down by 60% in a 30% gold drop, well, then that stock price is probably going to go down by about 60%. But if they also have debt and the market is concerned, hey, I'm not sure if they're going to be able to service this debt or pay that back, well, then you could see the stock fall by 80%, by 90%, just by a 30% drop in the gold price. Whereas your question was about the big three royalty companies. What role do they play? Well, if gold falls by 30%, Franco-Nevada's margins are still going to be 90%. They're about 90% today. If the gold is 30% lower, they'll still be about 90%. It really doesn't make much of a difference. It might make 1 or 2 percentage points difference, but the margins barely move at all. So what that means, if the gold price falls by 30%, yeah, those stock prices will probably come down, but they'll probably come down about 30% along with the gold price. So for that reason, it's much safer to own the major royalty and streaming companies at the latter stages of a bull market than it is a gold producer, for example.
From your perspective, speaking of those three big royalty streaming companies, which one do you think right now is the best position to grow organically?
The company that has the biggest war chest is Franco-Nevada, because they have, if I recall correctly, an undrawn credit facility and a whole bunch of cash right now. However, the company that has the most growth already built in is Wheaton Precious Metals. Wheaton Precious Metals is going to see close to 50% growth over the coming few years, based on things they've already purchased. Now they still have some payments to make, because the way they structure most of their deals is that they pay they pay a little bit up front and then they pay the amount as the mine gets constructed. So they might be paying for a deal over the course of 2 or 3 years. But yeah, Wheaton Precious Metals has the most growth. Franco-Nevada, although they have the biggest war chest to buy new projects, they have the least amount of growth of the three. They only have about 14% growth. Their growth profile improves significantly if Cobre Panama comes back online. But if it doesn't, they don't have much growth. And then Royal Gold has a lot of growth as well. If you're using 25 as a baseline instead of 2026, Royal Gold is right up there with Wheaton Precious Metals in terms of the growth profile. If you use 2026 as your baseline, well, then Wheaton Precious Metals is quite a bit better than Royal Gold. But yeah, recently Royal Gold put out their 5-year guidance for the first time. Normally in the past, they didn't do that. And they said they should grow to about 455,000 ounces in 5 years, which which is not big growth. It's like 18% or something based on 2026, using 2026 as a baseline. Uh, However, that leaves off their Hod Maden asset. And Hod Maden is highly likely to be in production within 5 years. And also, cutting Royal's growth profile off at 5 years leaves out enormous projects they have coming online. For example, Glencore's Mara project, they have the option to buy a huge gold stream on that. Phase 3 of Ivanhoe Mines' Platreef project is coming online, and phase 3 is going to be producing way more than phase 2. So, and then you have Barrick's massive 4 Mile project that should be coming on around that same time. That's not included in guidance. So just by extending that 5 years out to 6 years, you add about another 50,000 ounces, another 50,000 geos to that. So when looking out 6 years, Royal Gold is going to be almost the size that Franco-Nevada is today. So in a lot of investors' minds, they have this idea that Royal Gold is way smaller than Franco-Nevada. But just in 6 years, based on assets they already own, or basically based on only assets they already own, they have to pay a little bit for an option here or there, but they don't have a lot of capital outlay to get that. So based on assets they already own, they're basically almost going to be as big as Franco-Nevada is today. So just to put that in perspective.
You spoke about that 30% equity stake that Royal Gold has in the Hod Maden Gold and Copper Development Project. This makes some investors nervous about Royal Gold. Are they right to be anxious about that in your view?
With a royalty and streaming company, one of the things that investors like about it is that you don't have the risk, you don't have the capex risk, you don't have the risk of capex going way over the estimate, and also you don't have the risk of owning a mine. You just get a percentage off the top, the percentage off the top line revenue, and investors like that. That's a very safe business model. It does introduce some risk having this 30% equity stake in Hod Maden. But they got this because they bought Sandstorm Gold, and Sandstorm Gold owned this asset. And for Sandstorm, Hod Maden was their single most important asset, or at least their most important development asset. But with Royal Gold, in terms of NAV, it's their 7th most important asset. So it's way less relevant than it was for Sandstorm, but yes, there is risk there. Now, if what Royal Gold wants to do is they want to sell their 30% equity stake and convert it into a stream or a royalty to more align with their business model and to make investors more comfortable with owning that asset. But let's just say they can't do that. Let's say, it's not that they couldn't sell it for a royalty or a stream. It's all a matter of price. Can they convert that equity stake into a royalty or stream that Royal Gold feels like they are fairly compensated for that, and that the royalty or stream is large enough to compensate them for giving up that 30% equity stake? Because, this is a 30% equity stake on what's going to be one of the world's most profitable copper and gold mines. Their 2026 feasibility study shows an all-in sustaining cost for gold of less than $600 an ounce. That's unheard of. And that's a brand new feasibility study. And if talking in terms of copper, you're looking at all-in sustaining costs of, or was it cash cost? Anyway, it was about $1 per pound of copper, which is also extremely low. But whether you look at copper or gold, it's going to be an extremely profitable mine. But let's just say, worst case scenario, they can't convert that into a stream or a royalty in a way that makes them feel like they're getting compensated well. What happens? Well, then they're going to be responsible for 30% of the cost of the mine build. And if it comes in on budget, that will be about $270 million. Easily payable through their cash flow. They're cash flowing about 100 million ounces a month right now. And you have a 2-year mine build where they have to pay $270 million, no problem, right? It's basically like maybe about 1/10 of their cash flow per month goes to funding that mine build. No big deal. And then after the mine is built, they have a 30% equity stake in one of the world's most profitable copper and gold mines. And in the first few years, that's going to bring them about 75,000 gold equivalent ounces a year at extremely high margins. These are going to be margins that are right in line with a typical stream from, for example, Wheaton Precious Metals. Because at an AISC of $600 per ounce per gold, I mean, that's actually higher margins than what Wheaton Precious Metals has on most of their streams. So, I mean, looking at it like that, I don't think it's a huge deal. Yeah, you don't want the exposure to an operating mine, because if there's some disaster that happens at the mine, if something happens and miners get killed, suddenly Royal Gold is liable for part of that. And you don't want that risk as the owner of a royalty or streaming company. So it would be good to get that off the books eventually, but I think it would be a lot easier to convert that into a stream or a royalty after the mine is producing. And if that were the case, I think they could get a very high royalty for their 30% equity stake.
We've talked about the big three. Are there any smaller companies in the royalty and streaming space that you have your eye on or are investing in right now?
Elemental Royalty, I like them. They have a royalty on a huge copper and gold project. Actually, it's in Serbia. But yeah, so that Timok project, is Zijin's Kukurupeki mine, and that's going to grow a lot over the coming years. And I think as that grows, that's really going to increase the NAV of Elemental. So Elemental was combined with a business combination of Elemental Altus royalty and EMX royalty. So now it's Elemental royalty in one combined company. But yeah, I like that. Valuation today is pretty decent. Decent buy here. You could buy that today and hold it for the long term, and I think you'd be pretty well off. However, going back to my views on the economy, Elemental has about 30%, 35% exposure to copper, and the rest is gold. So if the economy goes into recession, the copper price is likely to come down quite a bit, and that could be an opportunity to buy Elemental royalty shares cheap. Another small royalty and streaming company that is interesting is Empress Royalty. So Empress Royalty, a little while back, it was getting to the point where I felt like it was overvalued, but now the stock price has come down a lot and it's more reasonable. But the team there has a really good history of intelligently deploying capital. They've gotten incredible returns on the capital that they've deployed. And they're now moving into a situation where, well, it used to be the case where whenever they bought a new asset, they would have to use their expensive credit facility that had an all-in cost somewhere north of 15% annually. So that's a big hurdle to overcome when you're looking at buying a new asset. It has to look very, very attractive for you to overcome a 15% annual cost of capital, plus get a return on your investment, plus account for any risks that you have to take. But now they're at a point where they're net cash positive. They have lots of cash on the books, and now they can deploy capital using cash instead of their expensive debt facility. So the thing with Empress, though, is they need to grow. They only own a few assets. They only own a few producing assets. And they say they're in talks and negotiations for $50 million worth of deals, but they haven't closed a deal in about 2 years. So my primary catalyst that I would be looking for with Empress is, can they close new deals? They've clearly been very picky. So we can be pretty sure that if they close a new deal, it's going to be one where the economics look really good for the company. But yeah, that's the primary thing I'm looking for with Empress. They need to grow, but will they close more deals, because they haven't in a couple of years. So yeah, those are a couple that I'm looking at in the gold and silver space. And I didn't mention this, but Empress is a gold and silver royalty company. Right now, they have a lot of exposure to silver.
And what about outside of the precious metal space? Any royalty companies that you're interested in there?
Labrador Iron Ore Royalty Corp. But again, going back to my views on the economy and the potential for a recession. If the economy goes into recession, iron ore prices are going to come down. But that would be one that's on my shopping list, waiting for an opportunity to buy it cheaper. Another one is Altius Minerals, diversified royalty company, really long life mines, excellent management team, perhaps the best management team in the business. At today's share price of 37, 38 US dollars per share, the valuation here is looking a little rich for me. I'd rather get in closer to $30 per share. But again, this is another company with exposure to iron ore, with exposure to copper. So if the economy goes into a recession, there could be a great buying opportunity there for Altius. So that's another one I like, but not at today's price.
You also noted that you recently sold one of your gold stocks. I'm wondering what the factors are that you take into consideration before you sell some or all of a position, and how you structure that. What is your exit strategy? Is it different for every company? Do you have a framework you follow? I'd love to know that.
Well, part of this was reducing risk as we get further into a gold bull market, because I don't know how long this gold bull market is going to last. I wanted to get the riskiest stocks out of the portfolio. And this was Endeavour Mining. So Endeavour Mining is a West African gold producer that produces, give or take, $1 million or 1 million ounces per year. It depends on whether you're using the attributable number of ounces or the number they report on a 100% basis. But yeah, their attributable ounces is about $1 million or 1 million ounces per year. But my valuation model told me it was risky. It was risky to own it here. And over the past couple of years, we've seen these West African countries where they operate trying to, essentially stealing the future value of the mine. Not expropriating the mine where they're going in there with their army and they're literally saying, get out of here, this is our mine now. But instead, they're stealing the future value of it. So how do they do this? Well, for example, Endeavour has 2 mines in Burkina Faso, their Houndé mine and their Mana mine. Okay, and based on the deal they had with Burkina Faso, when they built those mines, Burkina Faso had a 10% basically equity stake where they don't have to contribute the capital costs. So Burkina Faso owned 10% of the mine, right? Well, they just told Endeavour, hey, now we own 15% of the mine. Now we have a 15% free carry, not 10% anymore. So now you only own 85% of it. So in addition, that's not all though. In addition to that, they also changed the royalty structure. So Burkina Faso used to have a sliding scale between, I think it was 3% and 5% royalty. That's coming off top line revenue, right? And then gold prices went well north of $2,000 an ounce. And they're like, actually now the sliding scale is 3% to 7% based on the gold price. And so now based on today's gold price, this was back at that time, whatever it was, a year and a half ago, based on today's gold price, instead of paying us a 5% royalty, you're paying us a 7% royalty. And then the gold price kept climbing. And then Burkina Faso came out and they said, actually, there's no cap on the royalty anymore. It now is going to go up infinitely with the gold price. Every $500 the gold price goes up, we're increasing the royalty another percent. So today, Endeavour is paying an 11% royalty on every ounce. If the gold price keeps going up, let's say it goes up another $2,000 an ounce, they're going to be paying 15% royalty on every ounce produced. And this isn't like an income tax. Like, for example, in the US, the income tax is staged, right? So if for your first, let's just say $20,000 of income, it's at a really low rate. Then for your next $30,000 of income, it's at a higher rate. And then it's at a higher rate after that. No, this royalty rate applies to all the production. So now what used to be a 5% royalty is now an 11% royalty, and there's no end in sight if the gold bull market continues. So that was really driving up their AISCs and eating into the potential margins that they could enjoy from a higher gold price. And then they also have a couple of mines in Cote d'Ivoire, and Cote d'Ivoire increased their royalty rate as well. And they have a great development project in Mali, but Mali has done something similar, perhaps even worse than Burkina Faso, demanding like 35% free carried interest instead of Burkina Faso's 15%. So they're just letting that Mali development project sit there, even though it's a really good project. So yeah, those West African countries are really stealing a lot of the future value of the mine, even though they aren't outright expropriating the mines. So that fact. So there's that fact, and then there's the fact that my valuation model that I built was telling me, hey, Endeavor stock is getting pretty risky here. And then there's the fact that I don't know when the gold bull market is going to end, and owning a producer is more risky than owning a royalty company. And then there was that pillar. So it was kind of those three pillars that made me think, hey, I need to get this out of the portfolio.
That's a great analysis. And I think there's a lot of lessons to take there when it comes to exiting positions. I think me and you both have a similar approach to investing in the commodity sector, which is looking for more surefire 2 to 3x returns on a consistent basis, as opposed to getting deep into the weeds on potential 10 baggers and hoping to hit massive home runs. The Don Durrett style, where he's invested in like 168 different stocks or something like that, and he's strictly focused on stocks with 10 bagger potentials. I'm not saying that doesn't have its own place, and Don's obviously incredibly knowledgeable. I'm actually having him on the show soon. But it's a very different approach, and one that entails less risk in that sort of world of 10 bagger talk, and the mining stock world that is also an incredibly volatile sector where everyone is trying to make life-changing gains. How do you control your FOMO and keep your emotions in check? I'd love to hear about that.
Growing up, my dad was a financial advisor, and I think I probably learned at age 8 or age 10 that you buy low and you sell high. So I mean that's been ingrained in me from an early age. So that actually makes it pretty easy for me to not act on FOMO. It's actually, I find it pretty difficult to push the buy button after a stock has gone up a lot, unless I've taken the time to really know the company and I've built a valuation model and I can see, hey, even though the stock has gone up a lot, this is still a really good value here, because things have changed with the company, or things have changed with the company, or things have changed with the commodity price so much that it has totally changed the valuation dynamic. So there's that. But yeah, I mean, if you really want to build wealth and you can focus on getting rid of your downside risk, so those losses don't kill you. For example, if you suffer a 90% loss on a stock, you need a 900% gain just to get back to even. If you suffer a 75% loss on a stock, you need a 300% gain just to get back to even, just to get back where you started. 300% gains are hard. 900% gains are very hard. So the math makes it very difficult to build long-term wealth if you're taking big losses. There's certain people who've been able to do it. Eric Sprott comes to mind. He's willing to take extreme risks. He's extremely patient. He has a lot of capital, and he's willing to be wrong for years and stay the trade to eventually get those big wins. Most people aren't built like Eric Sprott. I feel like most people, well, very few people have that capital, and most people don't have that discipline and risk tolerance that he has. But back to really building wealth. So if you can avoid losing money where the winners take care of themselves, you can build wealth really fast. It does not take a lot of doubles or triples to get extremely wealthy in your life. Like I'm saying, if you your capital you have today, you triple it, then you triple it again, and you triple it again. I mean, that multiplies exponentially, and you can build wealth very, very, very quickly, and I would say much more assuredly than you can by chasing those 10 baggers and 100 baggers. I know 10 baggers and 100 baggers are super exciting, and I chased those earlier in my career. But earlier in my career, I made lots of mistakes, and if I had used my current investing method versus what I was doing then, I'd be a lot better off today than I am. But because I was taking those huge risks, and because I felt like, hey, I don't have much capital right now and I need the 10 baggers, I didn't get the 10 baggers because my mindset was not right for that. I was not at the right point in my life to do that. Like now I have much more capital. I'm much more prepared to be patient, to do the things that are needed to do to be able to get the occasional opportunity like that. But yeah, the vast majority of my focus is on those 2 and 3 baggers, not the 10 baggers.
And final thought before I do let you go, because this has been such an extraordinary conversation, I just want to pull a thread on something that you've spoken on just now. Have you had the experience where you got out of a position at a 2 or 3x only to see it run to a 4, 5, 6, or even 10x? Have you had that experience before? And how did you deal with that?
I was in Bitcoin really early.
Wow, that okay.
And yeah, I got out of Bitcoin when there was a hard fork that I felt like was not the right path forward for Bitcoin. And yeah, I sold at $2,000. And then I saw it go up more than 50x from there. But how did I deal with that? To me, it wasn't emotionally taxing. It was actually pretty easy because I was just focused on what's next. Where do I put my money now? What's the best place for my money today? And just doing that, and being focused on the present, it makes it easy for me. Like, yeah, I could dwell on that and be looking at how much money I would have today if I had held Bitcoin through all those times. But I mean, what's that going to do for me? It's not going to do anything for me. It's going to put me in a bad mood. It's perhaps going to make me make bad decisions trying to make up that money some other way. And I don't think that's a very healthy way forward. So yeah, it doesn't bother me. I'm just looking at what's the best possible investment now. It reminds me of what Warren Buffett says, how investing is like a game of baseball where there's no called strikes. So, I mean, I miss out on opportunities all the time where there's doubles and triples, but I specifically avoided the investment because I saw a risk that I wasn't willing to take. Again, protecting my downside first. So it's only when that I see the potential and I see downside protection that I pull the trigger. Or wherever all the stars are lining up that it looks like that this bet is highly, highly likely to pay out. Then I pull the trigger and I bet big. But yeah, I mean, there's countless opportunities where I was looking at a stock, I was seriously considering buying it, and then I decided not to because there was some risk or some series of risks that I wasn't willing to take because, again, downside protection first. So I didn't bother with it. And then I see the stock go up 2x or 5x, or even there was one recently that's up 15x in something like 4 months from when I was looking at it. And it doesn't bother me at all. Literally doesn't bother me at all because that's just, I have my investment criteria. And if it doesn't fit it, it doesn't fit it. Simple as that. And yeah, I miss out on a lot of big winners in a bull market. But you know what? When the market turns, my strategy protects me from taking big losses.
I love that. So, for those who want to follow along with you, what you're investing in, and learn more about your strategy through Mining Stock Monkey, how can they do that? And I think you've got a special offer for viewers of this show as well. Why don't you break that down for us?
Yeah, sure. If you like the way I think, if you think that my investing style fits with the way you want to invest, well, then I recommend signing up for my research service. Right now, you can try it out for 3 months for 50% off. Get 50% off your first 3 months, but it's limited to the first 30 people who sign up. Last time I was on Jesse's show, I made a similar offer. I think this offer is a better one. And that offer sold out. So I think this offer is highly likely to sell out too. If you click on the link in the comments or description and it doesn't show the discount, that means it's already sold out.
Excellent. Well, I will put that link in the description and the pinned comment on the YouTube episode, as well as in the show notes on the audio podcast version of the show. Jordan, fantastic conversation. You shared some great insights today. Thank you so much for coming on.
Thanks for having me on, Jesse. It was fun.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.